All right, so good afternoon and welcome to chapter 6, all right, of your Principles of Taxation course. And here we are looking at Social Security and pension funds. It's a very simple aspect and it is 5 mark in your exam, so you don't have to let it go at all. All right, so what are we supposed to know here? All right, okay, you are supposed to really understand and also know that we have a pension act. So we have the National Pensions Act, which the new one was in 2008 at 766. All right. And the Act 766 talks about the three-tier concept, all right, the three-tier scheme. Those who are in charge of making sure that these three-tier scheme are regulated, and also these every employer, employee, the parties are adhered to are the National Pensions Regulatory Authority. Okay, so get to know that. Now, what is the three-tier scheme? So we have three-tier scheme. And in this scheme, we have tier one. Tier one is compulsory. So you have to understand that it's compulsory. It's mandatory. All right. And that is the tier one. And the percentages that every person is supposed to go through to have, we have the mandatory tier one, we have the employer. So what we are looking at, bear in mind, is this thing is a formal employment, all right? Formal employment. So we have the employer and we have the employee. All right. In the tier one, what happens is that the employer is supposed to contribute 13%. And please, all the percentages are on the basic salary. All right. Basic salary. All right. Take note of that. And the employee also contribute to tier one of 0.5%. So together, it is what? 13.5%. And that is managed by a National Pensions Trust, which is SNIT. All right, so take note of that, SNIT. So it's not a private entity that will be holding this, it's a national state. All right, Social Security and National Insurance Trust, they take care of this one. And when they receive this 13%, what happens is that out of the 13%, 13.5%, 11% is actually managed under SNIT, and the 2.5 goes to your NHIS. All right, so you have to understand that. So everybody is actually paying NHIS so long as you are paying your SNIT. All right, so that is that. All right, so that is the first tier. Okay, that is the first tier. So we go to the tier two. Tier two. We will come to the tax implications of these things later. Tier two. Tier two is also compulsory or mandatory. All right, and that is paid by only the employee. the employee, and that is 5%. All right. But it is managed by the employee's own preferred pension provider. All right. So here you can choose. So it's private. All right. It's not compulsory that it has to be the state owned. You can choose. For example, some people will choose Hollard to manage it. Some people will choose Enterprise. All right. We have so many of them. Glyco is there. I mean, so many. All right. So you choose privately and they will manage your 5%. All right. But it's compulsory. It's compulsory. It's compulsory. So take note of that. So together you realize that these percentages, which is 18.5%, are all what? Compulsory. Compulsory. It's just that out of the 18.5, 5% is managed by a private person. All right. Okay. Then we have the tier 3. Tier 3. Now, the tier 3 is not compulsory, it's voluntary. It's voluntary. But who pays? That one depends. The employer can pay all by himself or herself. It can also be by the employee, or it can be shared among them. Now, whichever case it will be, you have up to 16.5%. Because in all, your SNP or your pension should be 35%. So we have 18.5 mandatory, then the remaining 16.5 voluntary. All right. So basically that is that. So please understand that in all, it should be 35%. Now watch this. Employer alone can pay for you your 16.5%. Employee alone can decide to pay the 16.5 himself out of the basic. It can also be shared. Let's say the employer would take like 8.25. If you get entities that do this, employer does this for you, just thank them, okay? And the employee can also pay. So together, whichever case may be, it should be 16.5. All right. So that is that. But this 16.5 is also privately managed. So you choose the entity you want them to manage. All right. So this one to privately manage. But as for tier 1, is state managed. Okay. All right. So that is that. So this is it. This is your 3-tier scheme that you have to know. Now, what are the tax implications in these? So let's look at the tax implications in these. And because we'll be doing employment income in lecture 7, and you have to understand how these things can affect. But in your exam, if you are asked to explain the 3-tier scheme, this is your 3-tier scheme. It's just that let me add that for the informal sector people, so the self-employed people, so those in the informal sector or the self-employed, for them is voluntary and they can contribute the 35%. All right. There is no employer-employee because they themselves are the employee and they themselves are the employer. All right. So, and it can be privately managed. So they have a choice. Well, they can choose to let SNP manage it for them. But most of the time, people want private sector than even the public sector. All right. So that is that. Okay, so these are the issues that you need to understand. Now, let me just brief you about the tax implications of these things. So what will happen is that if your employer pays the 13%, in terms of assessing you for tax, the 13% is added to your assessable income. Take note of that. It's added to your assessable income. All right, because according to Section 4 of Act 896, anything that is a gain, anything that you receive, all right, in connection with your employment is actually part of your assessable income. All right, so that is that. Now, even though it is part of your assessable income, once you've added it to your assessable income, you also less it as a relief. All right, you also less it as a relief. So it is add, subtract. One would say, then why do we have to bring it in the first place? I'll show you when we are doing employment income. I'll show you that, all right? Because it is needed for the determination of some type of allowances. All right. Okay, so that is that. So the 13% is added to your assessable income and also deducted as a relief. All right, so take note of that. The part that the employee contributes, these two are reliefs. So you don't add them to anything. You then deduct it as a relief. All right, it's a relief to the employee. All right, so take note of that. Now over here, it is voluntary, it's not compulsory. And so if the employer pays it for you, the entire 16 for you, then that one will be added to your assessable income. It's added to your assessable income. All right. That is that. But if the employee is the one that paid everything by himself, it is given as a relief. All right. It is given as a relief. It's not added to the assessable income. It is given as a relief. All right. So take note of that. Again, so when it is shared, the part that the employer will pay will be added to your assessable income, and it will not be deducted back. But the part that the employee pay will not be added to your assessable income, but rather be given as what? A relief. So get the differences correct. All right. So that is that. Okay. Now, another tax implication you must know is that this tier 2, all right, is given to a private entity to manage. And so therefore, what happens is that you cannot, if you want to withdraw, you can't withdraw. But if you have 10 years, so if you withdraw within 10 years, it is taxable. So withdrawal within 10 years is what? Taxable. But withdrawal after the 10 years is exempt from tax. All right, withdrawal after the 10 years is exempt from tax. So please know that. Now, when it comes to the tier 3, the voluntary, or the term we usually have come to know of it is providence. All right, providence. Okay, by tier 3. All right. So now, that one too, you have 5 years. So if you withdrawal within 5 years is taxable. It's taxable. Then withdrawal after 5 years is exempt from tax. After 5 years is exempt from tax. All right. Take note of that. Very, very important. Take note of that. Okay. Of course, these ones, if the informal sector person contributes, that one is also given as a relief. All right. So take note of that. Okay. So now this is the three-tier scheme and their tax implication. So bear in mind that. Another thing you must understand is that the compulsory one, you have to pay it within 14 days. So the remittance is within 14 days. Okay. The remittance is within 14 days. So what you have here is that the remittance, the compulsory one, as for the private one. In fact, all pensions are supposed to be filed or, remitted to their respective management, those who are managing it, as by 14 day of the ensuing month. So 14 day of ensuing month. So assuming today we are in January, we are in February, January SNET tier 2, everything has to be filed on by February 14th. Okay, so vast day. Don't enjoy to forget that you need to file your pension. All right, don't enjoy. Okay, so that is that. That is that. Let me dare say that. Let me come back to this one because I said it's giving us a relief. Yeah, but there is a part you are the one that is paying all the parts. You see, like I said here, you do remember that if the employee is paying all the parts, it is also giving us a relief. You remember? All right. So that is the explanation. There is the 13.5, all right, that is given to you. I mean, those ones are like your employer giving, and those ones are also. So this 13, your employer would have given, and it's added and deducted. You saw what we did here, added and deducted. So if you are the one doing the 35%, means you are both the employer, you are the employee. All right. So that is that. That is that. All right. Now let's come to, so the remittance is that you have to remit it. And so please, by law, don't be late about it. Just remit it and be free. All right. Okay, so that is that. But you also have to understand the fact that for you to qualify for these payments, the age limit is that it should be a minimum of 15 years. All right. If you are 15 years old, you can start contributing to your pensions. But to be able to do this too, you have to have a minimum of what? 45 years. I will explain to you why they make the maximum years 45 years. Because the thing is that everybody by law must retire at what age? 60 years. And by law, to qualify for these SNAIT payments, you need to have contributed for 180 months, which is 15 years. So if you are 45 years and you contribute 15 years, you are 60 years. All right, you can retire. Okay, so that is that. That is that. Now, if there is early voluntary retirement too, and that one is 55 years. Okay, we call it superannuation. Now, the superannuation concept of SNAIT is that you have to retire at 60 years, which is the compulsory age, because Ghana, our compulsory age for retirement is 60 years. So compulsorily, the age for retirement is 60 years. But you can also retire voluntarily, all right, at age 55 years and still qualify for your pensions. All right. It's just that you will suffer some small early retirement percentages. All right, so that is that. Okay, let's look at some scenarios here before we just go into the past questions, then we are through with this. Is that you must understand that sometimes things happen natural. I mean, certain things happen. Somebody may not be able to, like I said, you see, I said that you need to contribute like what, 180 months, right, to qualify, or 15 years. 180 months is 15 years. But what if you are not able to? If you are not able to, in that case, they won't give you, the idea is that when you retire, Senate will be paying you on monthly basis. Okay. But what happens is that if you are not able to meet the 15-year gap, then what is going to happen is that you will be giving your contribution, all right, plus an interest. The interest is calculated by giving you 75% of the prevailing treasury bill rate at the time, prevailing TB rate. So assuming your contribution is 10,000, prevailing TB rate is, let's say, 30%. There was a time in this nation the TB went to 35%. So you might have been fortunate. So now, if that is the case, what we are going to do is to calculate 75%. So plus 75% of the prevailing TB rate, which is 30%, to give us the rate, and we will multiply that rate by on your money. All right, so how much would that be? 0.75 multiplied by what? 0.30. That gives me 0.225. That's like 22.5%. All right, multiply by 10,000. So you have your 10,000 here. Okay, so if I multiply this by 10,000, I'm having, so it will be 10,000 plus 2250. And that gives me what? 12,250. So that is what you will get. All right, that is what you get. The law says that if you die, this figure will be given to your beneficiary. All right, but if you die without stating your beneficiary, you know what we learned in senior high school, interstate law 111. Do you remember? PNDC law 111 will apply. All right, so that is that. Okay, that is that. So you have to get these things down, just in case. It helps you to know your own SNIT computations. All right, so that is that. All right, so get to lay hold of this knowledge, and it is beneficial. Now again, somebody too might not meet the 15 years because of an accident. All right, I mean, it happens that you are on course, you are doing your work normal, then something happens and you cannot work anymore. So if that happens, then it means that what you need is that you need a letter from the medical board, a report from the medical board, Ghana Medical Board. All right, you will need that before you can get your SNIT, because you couldn't meet the 15 years. All right, and you can't meet it because probably you are incapacitated now. You can't do it. You need a report from the medical board, and you must have contributed 12 months within the last 3 years before this issue happened. All right, within the last 3 years. So that is like how many months? 36 months, right? Yeah. So within the last 36 months, you are must have. So it means that when that issue happened to you, or an accident happened to you, you were already contributing. All right. So that is that. So the whole idea is that if you just started and the accident happened and you're incapacitated now and you have not met the 12 months, it means that you can't benefit from SNIT paying you on monthly basis. So that is that. So in that case, they will apply this concept for you. All right, so that is that. But at that time, your contribution is probably small. All right. Now, how do we do the calculation for this SNIT or your SNIT benefit? How do we do the calculation? Now, it's simple. The formula is simple. The formula is that we need to average your best. So average of your best 36 months salary, average of best 36 months salary. 36 months is 3 years. All right, average of the best. So you multiply it, you add all the 36 months salary, or if it's given in 3 years, you add all of them up, then you divide it by 3. Multiply by your pensions, right? Your pensions, right? And I'll explain to you your pensions, right? Then if you retire early, we have the early retirement reduction. Early retirement reduction factor. This is in percentages. Early retirement reduction factor is also in percentages. All right. So what are these early retirement reduction factors, and what are these pension rights? All right. Of course, your average best 36 months salary or 3 years salary, you will get it, you add it. So you add maybe year 1 plus the year 2 plus the year 3, all divided by 3. If it is given in months, you add all of them. All right, all the 36 months too. You multiply it by your pensions, right? Now, pension, if you contribute the first 15 years, you will earn a right of 37.5%. All right, 37.5%. Any extra year that you do on top of your 15 years, any extra year gives you 1.125%. Any extra year gives you that. All right. So assuming that you work for, let's say, 15 years, or let's say 16 years. Somebody worked for 16 years. What do you think will be his pension right? His pension right, the first 15 years will earn him 37.5%. Then the extra 1 year will earn him what? 1.125%. So in all, such a person will earn a 38.725, right? Percent. So that is what you'll be multiplying. But you see, this point, according to the law, ranges from 37.5% to 60%, meaning nobody can exceed the 60% in terms of the right. Nobody. So let's keep doing some example. Let's say somebody has how many years now? Let's say a person has, for example, the person has worked for like 30 years. Let's see. If you work for 30 years, your first 15 years grants you 37.5%, right? Then there's other 15 years. The extra 15 years will be what? 15 multiplied by 1.125. And what would that give us? 15 multiplied by 1.125. That gives me 16.875. If I add it to the 37.5 that I already have, it means such a person will be earning a point of 54.375%. The person is within the range. Okay, now let's look at somebody who works for 36 years and see. Who has contributed, not worked per se, but has contributed SNIT like 36 years. So in that case, what will happen? His first 15 years grants him 37.5%, right? Then what about the 16? How many years again? So that will be 21 years. All right. 15 plus to get the person the 36 years. So it will be 21 years multiplied by 1.125. All right. Now, if you go back and see this, we said that the limit should be 60%, right? So 60%, if you divide it, you deduct from the 37.5, meaning that the remaining anybody can get, apart from the first 15 years, is 22.5 points. Now, let's come to our question here. So if you multiply 21 years by 1.125, I get 23.625. 23.625. Meaning that when I add this to the 37.5, what is going to happen is that this man will have 61.125. But because it has exceeded the 60, his pension right will be limited to only 60%. All right, so that is that. That is that. All right, so please take note of that nobody can exceed the 60%. Now, the pension retirement reduction factor is that one too is a simple thing. You have to try and keep it in your head. So the age span from 55 years, 56, 57, 58, and what, 59, because at 60 is not an early retirement because the compulsory age is 60. Now, here, if you retire so early at age 55, you are going to get a reduction factor of 60%. If you retire at 56, you will just add 7.5, all right? So it will be 67.5. Here, you just add another 7%, which will be what? 7.5%, which will be what? 75, right? Then here will be what? 60. If you add 7.5 to this one, it will be 82.5, right? Then if you retire at 59, it will be 90%. So depending on the age the person retired, you have to multiply it by that reduction factor also. All right, so that is how it works. That is how it works. All right, so all that we need to do is to pick some example and work out this. So let me bring up some examples. So let's look at these examples. T worked for PTS for 25 years and retired at age 60, so there is no early retirement then. He earned 12,000 annually and has 300 months of contribution to his credit. So like you can see, the first 15 will be 37.5%. The extra 10 years, you earn this point. All right, so if you multiply now, you will get this amount. That's the pension. Then if you want the monthly, then you will divide this thing by this figure by 12. All right, so that is that. Assuming he retired at age 59, then it means it would have been, yes, you multiply these by 90% early retirement at 59. All right, so when you divide it by 12, you get your answer. So it's as simple as that. Easy, just easy like that. So get the manual at 160 cedis currently, and you are good to go. So the past questions are there. It says that when the new syllabus started in November 2019, don't forget, very soon we are going to be introduced you to another fresh syllabus in November 2024. But nothing changed. All these things are already in, so nothing changed. Okay. So explain the 3-tier scheme. You know it. Tier 1, Tier 2, Tier 3. You know it. The same question was repeated for 5 marks. I've told you that this area is just a gift of 5 marks. Then again, you are being asked about the benefit, the main benefit and qualifying conditions. I think you know the qualifying conditions because as we have learned, nobody just qualify for the SNET. There are certain things that has to happen before. So what happens is that, especially, let's say, this is about the second tier, right? The second tier. Remember we said that you have to retire at age, what do we call it, 55 to 60 years. All right. That is that. If you are 50 years too, you can still get it, provided you can prove that you are unemployed. So that is that, to say that if you retire before age 50 in accordance with the terms and conditions of somebody's employment, you can qualify for your tier 2 also. All right, that is the tier 2. All right, so please try and understand it. All right. So if you can't work anymore, I said that you have to attach what, a report from the medical board. All right, so all those things come into it. All right, so be careful. Be careful. The benefit from that is something I'm going to talk about, very simple, and I'm going to use it to answer a question they normally ask, which is distinguish between defined benefit plan and defined contribution plan. This thing is taught in detail in corporate reporting, employee benefits. All right. So here I'm just going to explain it to you in a real world understanding. So you see the defined benefit plan, a typical example of your defined benefit plan is your tier 1. The one that is managed by SNET. You realize that we can actually define your benefit. Did you see that? We calculated your benefit. So that is how we do it. So here it means that at the end of your contribution, so you contribute some amount, like the way you do to SNET, all right? Then at the end, when you get to retirement, your employer doesn't. So in this one, employer has no liability on your retirement. No liability on your retirement. Okay. So what happens is that it is the duty of SNET to take care of you upon your retirement, and what you get is known. Is known. Okay, because we calculated some people's own. You know what you'll be getting. All right. So a typical example of this is tier 1. But when you say defined contribution plan is something that is not a defined benefit plan, which means that here you choose your private, the person who will manage your pension for you. Okay, so that is that. You choose. And when you go on retirement, the person you choose now becomes what? Responsible for your retirement. But the key there is that, you see, when you give the money to the tier 2, tier 3 people, so the tier 2 and the tier 3, what they do is that they invest it just like SNET will invest it. They will invest it. But for them, when you are withdrawing the money, you will get your contribution plus some interest that your contribution earned in the investment portfolio, because we are using your money to invest. So what you will be realizing is that even though you have contributed money, every time your money keeps going up. All right. So what is happening is that if your pension manager is good, is very, very good, it means that your money will be going up. That is why you have to choose the best for yourself. It means your money will be going up. But if they invest in a loss-making investment too, your money will be going down. So you really don't know how much you will get. All right. Like the SNET, you already know. Okay. So that is the difference. Okay. So in the defined contribution plan, you'll be making a fixed payment. Your fund manager will be investing with the money and be generating interest on your behalf. All right. So it will keep increasing your money. So you don't have, the only thing that is defined here is your contribution, not your benefit, because your benefit is variable. It can change. All right. So that is that. That is that. But for SNET, you know how much you are contributing. You also know how much you get. All right. So take note of that. All right. So again, in 2021, May 2021, they were asked to explain the three-tier scheme, which we've done. Then, like I said, distinguish between defined benefit scheme and defined contribution scheme, like I've just explained to you. Then in April 2022, they asked that Mrs. Akoto has been engaged by Madani Limited as a marketing manager for 30 years and is on an annual salary of 20,000. The following information relates to Mrs. Akoto. So throughout her working life, she has earned the best salary from Madani Limited. So it means that his average of best 3 years will be coming from Madani. And we know that Madani pays her 20,000 every year. So multiply by 3, divided by 3. All right. What about a pension right? She has 408 months. Okay, so 408 months in years will be how much? How many years? So 408 divided by 12, that is 34 years. So the first 15 years grants him how many points? Do you remember? It grants him 37.5, right? Then the extra 19, right, will be 1.125 each. So 19 multiplied by 1.125 is what? 21.375. Now, somebody will ask, what if you don't get years and it is 15 years and some months? Then it means this 1.125 divided by 12, you will know the point for each month. Okay, so divide it. So let's see. So this one will be 1.125. If you divide it by 12, you know the point for each month. So if you work for 15 years and some months, you will know what to do. Okay, so 1.125 divided by 12, that is 0.09375. So that is it. So if it is 15 years and some months, I mean, you know how each month point score, all right? So that is it. So in this case, we will have what? 58.875, right? Yeah, because 37.5 plus 21.375 gives us 58.875. When did she retire? Okay, age 60, so there is no reduction factor. So what will happen is that we will have 20,000 cedis multiplying 58.875%. All right, so if you do that, multiply by 20,000. All right, that gives me 11,775. All right. If they said her monthly, so monthly, I have to divide this thing by 12. So if I divide by 12, it means our madam here's her pension every month will be 8981.25 Ghana cedis. All right, so that is that. You are done. 5 marks. Good job. The next one in December, you are giving Mr. Johnson Romeski. For him, we were giving his last best. The best is 93,000 plus 96,000 plus 99,000. So you have to add all of them and divide by 3. How many months does he have? 300 months. So 300 months in terms of years. Or you can just take the 300 months and multiply it by this figure, because every month is like that. Okay. So 300 months. So if I have 300 months, in terms of years, that is like 25 years. So first 15 years gives us 37.5. Don't forget. All right. Then the extra 10, the 1.125 multiplied by 10 will give us 11.25. So in all, how many points? In all, the points is 48.75%. How old at what age did she retire? Okay, 60. So there's no retirement reduction. So when you do this, 93 plus 96 plus 99, all divided by 3 gives us 96,000. So it will be 96,000 multiplied by 48.75%. Okay. So 48.75. And that gives me 46800. All right. So his monthly, if I divide this thing by 12, that gives him or gives her 3,900. So that is that. Cool chop, you go. All right. 5 marks, you go. Okay. Explain the 3 tier. Explain it, you go your way. Last in July 2023 is the same thing. Explain the basics for calculating the pension scheme and the pension. So you have this, how you go around to do this calculation. It's just that when you finish, try and add in a case where a person doesn't complete the 55 years. All right. So that is that. Okay. So ladies and gentlemen, SNET is done and you are good to go. God bless you. We will meet again and tackle employment income. All right. Thank you. See you in lecture 7.